Okay, this sounds completely like a Hollywood script, but I promise you it is painfully real. Welcome back to The Explainer. Today we're diving into this unbelievable story of a massive crypto fortune that was built practically overnight and then completely, devastatingly destroyed just as fast. We're going to break down the 5 fatal flaws of crypto investing and the psychology that actually drives them. So, imagine turning 100 grand, $100,000 into $52 million in just a few short months. Can you even imagine that euphoria? That feeling of absolute invincibility? Well, that's exactly what one investor experienced during the massive 2021 bull run. But now, imagine watching all 52 million of those dollars turn to absolute zero. Poof, just gone. The craziest part of this whole story isn't even the sheer scale of the loss, it's the fact that it wasn't a stroke of bad luck. It was the direct result of a single, highly predictable mistake. And the truth is, thousands of people have watched entire fortunes vanish because of the exact same 5 repeated flaws. It's time we break down exactly how these financial catastrophes happen so you can protect yourself.
Okay, let's dive into this. Number 1, chasing the hype.
Fear of missing out, FOMO, has probably destroyed more wealth in crypto than literally anything else. Let's rewind a bit to early 2017. Bitcoin is sitting right around $4,000. It's this niche internet asset, right? But then it starts climbing. Fast forward to December, it's nearing 20 grand. Suddenly, it is everywhere. It's on the nightly news, your coworkers are obsessed with it, your cousins are bragging about their gains at dinner. And that right there is the exact moment retail investors feel that creeping panic of missing out. They pile in right at the absolute emotional peak, deeply convinced the line is just going to keep going up forever. But spoiler alert, markets do not go up forever. By early 2018, the bubble popped, crashing all the way down below $6,500. So those who bought at the top, they were left sitting on devastating 65% losses simply because they bought the hype instead of the asset.
And this brilliantly illustrates how human psychology just repeats itself perfectly. Fast forward to 2021, Bitcoin hits a staggering, totally euphoric peak of roughly $69,000 in November. Celebrities are buying in, stadiums are getting renamed, and once again the FOMO buyers are chasing those blazing headlines. And once again, the bottom just falls out. Within a year, Bitcoin plummets below $17,000. That's a brutal 75% drop. The market wiped out $1 trillion in wealth. Look, chasing what's already moving in the headlines pretty much guarantees you're buying at emotional peaks and selling at emotional lows. It is practically a mathematical certainty for disaster.
The reality is, smart investing is actually remarkably boring. You build a strategy, you set entry points based on actual research, and you treat a sudden, urgent desire to buy as a massive, glaring warning sign. But then there's meme coin gambling, that lottery ticket mentality. People pour money into assets with zero actual utility, stuff like Dogecoin or Shiba Inu, just hoping for a life-changing miracle. But here's the catch. For every single lottery winner who gets famous on social media, tens of thousands of ordinary people go to absolute zero. The Squid Game token is the perfect tragic example of this. It surged 23 million% in a matter of days. 23 million! People were literally mortgaging their futures to buy in, only for a catastrophic rug pull to happen. The anonymous creators just vanished with the cash, and the token became permanently worthless in seconds.
Which brings us to number 2, the leverage illusion.
Now, this right here is the specific devastating trap that turned our opening investors' $52 million fortune into absolute nothing. The math behind leverage is just brutal. Basically, leverage allows you to borrow money to make a trade significantly larger than your actual account balance. It feels like a total superpower, right up until the market turns against you. Think about it like this. In a regular trade, a 10% market drop means a 10% loss. It's annoying for sure, but it's manageable. You survive to trade another day. But apply 10x leverage, that exact same 10% drop doesn't just hurt your portfolio, it liquidates it completely. You are wiped out instantly. The exchange forcefully closes your position to cover the borrowed funds and your original capital is just gone. And in the wild, volatile crypto markets, a 10% swing? That isn't some rare anomaly. That can happen on a random Tuesday afternoon.
$1.5 billion. Let that sink in. That is how much was liquidated in a single market session during the 2022 downturn. In just a few hours, over $1.5 billion simply evaporated from highly leveraged accounts. People turn to leverage because, eventually, a normal 5% gain stops giving them that dopamine hit. They start chasing that adrenaline high, constantly cranking up their leverage until one minor, totally normal market correction wipes them off the map completely. Just like our $52 million investor, they learn the absolute hardest lesson in finance. Leverage doesn't just multiply your gains, it ruthlessly multiplies your mistakes.
Moving on to number 3, the custody crisis.
So we're shifting gears now from trading errors to storage errors. Not your keys, not your coins. It is an absolutely legendary mantra in the cryptocurrency community, and honestly, it's written in the tears of everyone who ignored it. We so often leave our crypto on digital exchanges because, well, it's fast and it's easy. But that convenience comes with a massive hidden trade-off. When you buy assets on a platform like Coinbase, Kraken, or Binance and just leave them sitting there, you don't actually hold your cryptocurrency. You only hold a digital IOU. You are completely trusting a third party to give you your money back when you ask for it. And historically, that promise has been broken time and time again.
I mean, history is just littered with collapsed exchanges that left millions of innocent users with absolutely nothing. Let's look at November 2022. FTX, which was valued at a staggering $32 billion and run by the supposedly brilliant Sam Bankman-Fried, imploded in days. Over 1 million people logged into their apps to find they couldn't withdraw a single cent. Why? Because Bankman-Fried had secretly used their deposits to cover his own colossal trading losses. And FTX is far from alone here. The lending platform Celsius abruptly froze all customer withdrawals back in 2022, locking up billions. And of course, the granddaddy of them all, Mt. Gox, collapsed way back in 2014, losing 850,000 of its customers' Bitcoin. When you trust a company with your private keys, you're basically gambling your entire net worth on their internal management. Now, the solution to this is pretty unglamorous, but it is entirely bulletproof. It's the exact playbook used by serious long-term investors. Step 1, keep only your active day-to-day trading funds on an exchange. Step 2, acquire a cold storage hardware wallet. Basically, this is a physical device that holds your private keys and remains entirely disconnected from the internet. Step 3, move your long-term wealth off the grid and onto that device. By taking total personal control of your digital assets, you guarantee that no corrupt CEO, no bankrupt exchange, and no frozen server can ever mismanage, gamble away, or deny you access to your hard-earned funds.
That brings us to number 4, phishing and fake promises. $40 billion, wiped out in just 72 hours. Let that number wash over you for a second. When the algorithmic stablecoin Terra Luna imploded, it wasn't your traditional phishing scam, but the psychological manipulation was identical. The system promised this completely unsustainable 20% annual yield just for holding the token. In a world of low interest rates, that promise acted like a siren song. But when the fundamental flaws in the code broke the system's confidence, the price plummeted from over $80 down to less than a single cent in a matter of days. People lost their entire life savings, college funds, retirements, all because they were blinded by the illusion of a guaranteed, risk-free high return. If something offers completely disproportionate rewards with zero apparent risk, it is almost certainly a mirage.
To survive in this space, you have to adopt some strict, non-negotiable security habits. Seriously, treat them like the laws of gravity. Never click links in unsolicited emails, even if they look exactly like they're from your exchange. Always type the exchange URL directly into your browser to avoid those incredibly convincing, identical-looking fake sites designed just to steal your login. Enable two-factor authentication using a dedicated authenticator app. Please do not use text messages, which can easily be intercepted by SIM swap attacks. And finally, never ever send crypto to receive crypto. If an account claiming to be Elon Musk or some famous CEO messages you promising to double your Bitcoin if you just send a little bit first, it is a scam. Every single time. No exceptions. And finally, number 5, the emotion engine. So the crucial point is this. There's a single thread connecting every massive financial loss we've just covered: emotion overriding logic. Bitcoin and cryptocurrency as technologies are not inherently the problem here. The blockchain works exactly as programmed, and it's grown into a multi-trillion-dollar asset class that operates seamlessly 24/7. The fatal flaw, the real danger, has always been human behavior. We are just wired to panic, to be greedy, and to trust when we really shouldn't.
Think about it. Every fatal flaw maps directly to a deep psychological trap. FOMO is driven by the primal fear of being left behind by your peers. Meme coin gambling? That's fueled by raw, unadulterated greed disguised as an internet joke. Using massive leverage isn't a trading strategy. It is sheer overconfidence and adrenaline seeking. Leaving your life savings on a centralized exchange is prioritizing minor convenience over absolute security. And falling for scams happens because malicious actors manufacture fake urgency and exploit your misplaced trust. Wealth in crypto isn't destroyed by the market charts. It is destroyed by decisions made by human beings in temporary moments of panic, greed, or hubris.
That investor who lost $52 million didn't just have a run of bad luck. He let emotion take the wheel. He got greedy, he used leverage, and the market punished that emotion with absolute zero. So, the next time you look at your portfolio and you're preparing to make a trade, ask yourself one simple question. Is your next decision driven by logic or by emotion? Thank you for joining me on this explainer. If you want to survive and thrive in complex, high-stakes markets, make sure you subscribe for more deep dives into the strategies and stories that shape finance. See you next time.